right, so this is the doctoral dissertation, okay, that I developed. And it's basically 20 years of work experience in applying modern portfolio theory. So I basically, over like a 15-year period, I was basically doing research for large institutional real estate investment companies. So pension fund advisor, REIT, and then I also had my own consulting company. But throughout the whole career, throughout the 15 years, was really designing portfolio strategy for these large institutional investors. So the task was, Larry, will you build us a portfolio strategy? Because the problem is that our acquisitions people are basically bringing us transactions and selling them to the investment committee with no strategy. So they're basically just bringing deals from all over pretty much the Western region with no market focus, no allocation, no analysis whatsoever. And they said, we need a research-driven portfolio strategy so that not only that we know where we need to go buy these properties, but how much of the portfolio should be allocated by market. And we need a research-driven strategy so that we can go to the institutional investors and say, we have a research-driven strategy, give us billions or millions, hundreds of millions of dollars, because we know how to deploy the capital. Okay, so it was an institutionalization, of the organizational structure. And this was, it started in 1996 is when we started the effort. And then by 2005, it took us like 5-6 years. By 2005, we had doubled our assets under management as a real estate company from about 800 million to 2.2 billion. And then the company eventually went on to double again to 4 billion, and then the company got bought out by a larger acquirer, and that company added the portfolio to their portfolio and became one of the largest apartment REITs currently, in the space. And I think they're around 13 billion right now. So what I did was I took basically your investments book and went through it and used a lot of the methodologies from that book, and then also used Markowitz's modern portfolio theory and readapted it and created modern and postmodern real estate portfolio theory. So I invented the acronyms, modern and postmodern real estate portfolio theory. So MREPT and PMREPT. Okay. So this dissertation is basically a brief of the methodology in which I went through over the 15 years to basically create the modern real estate portfolio theory in application. But then the last piece of the research was, once you've built the portfolio, then what you need to do is to find an index that basically tracks the performance of the portfolio, and then use the derivatives based off of the indices to either go long your view or to use the derivatives to hedge off the real estate market risk. Now, the effort to design the indexes started in 2006, and actually they had done some preliminary development in 2005. They hired me in 2006. The first year I had really no resources, so me and another analyst were basically developing it with a programmer. It took us a year to build the methodology and build the mousetrap. By April of 2007, we had launched the indexes in conjunction with Standard & Poor's. So basically we built the Standard & Poor's real estate indexes. And then we were also working with the Chicago Mercantile Exchange. And the Chicago Mercantile Exchange launched the standardized futures contracts and the options on the futures contracts based off of the indexes. And the goal was to basically revolutionize how people invest in real estate. Because currently they either invest directly in real estate, into individual properties, or they invest in commingled funds, which are like closed-end mutual funds, or they invest in exchange traded funds or mutual funds in real estate investment trust securities, or they invest in commercial mortgage-backed securities or the fixed income side through mutual funds or some other type of closed-end vehicle. There was no derivatives, there are no derivatives for real estate, commercial real estate hedging or investment. It doesn't exist. We launched the indices in April of '07. By 2008, Lehman Brothers had gone bankrupt. That basically wiped out and impaired most of the investment banks that would create a market in these types of products. And basically, me and my team were shown the door by January 2009. It was basically get out. So we basically left. And then for a year, I traveled the United States looking for a position of similar level, and there was nothing there in 2009 or even 2010. So in 2010, what I did was I went back to my dissertation committee at Golden Gate, and I said I want to finish the dissertation, and they said, okay, well, you need to defend it, so you got to put the defense together, and you got to give us a draft of the dissertation. So I spent a few months putting together that paper, and then I went to for New York Life for 4.5 years. And at the end of the 5th year, I went back to Standard & Poor's, and I said, I want to publish my dissertation based on the research that I had written for you guys. And they said, well, let me send the sections of the dissertation through our legal and our compliance departments to make sure that it's okay. So I waited 5 years so I could gain access to the intellectual property. I waited 5 years. And then I went back to S&P and asked them for the rights to be able to publish the documentation within the dissertation. I went back to the Chicago Mercantile Exchange, did exactly the same thing. They signed off on the content and the methodology to use in the dissertation. And I went back to Charles Schwab and asked them for exactly the same thing. So I had gone past the 5 years of statutes of limitations. So I basically owned the methodology. And I got written sign off by all 3 of the entities that could have kept the IP, but they basically allowed me to publish it within the dissertation. So that was a very strategic move on my part, to make sure that I had rights to be able to publish the dissertation without being accused of plagiarism. Because a lot of the materials that I wrote for S&P and Schwab and the CME, they branded it under their brand and pushed it out as content to their clients. When you do a dissertation, if you get caught plagiarizing, that's it, your career's over. So I had to be very careful that they signed off on everything that I had published through them and not be accused of the plagiarism. So the thesis of the research was, how do you build a multi-billion-dollar portfolio of real estate using modern portfolio theory? How do you build indexes that track the performance of those portfolios or that portfolio? And then how do you utilize property derivative contracts to hedge off the risk associated with that portfolio? So it's an integrated paper. And I was lucky I didn't publish the dissertation earlier, because it was incomplete. Okay, now it's a totally complete dissertation. I gave you the dissertation, I gave you the PowerPoint presentation, and I also gave you the questions that you should be filling out in your blue books, or on pieces of paper as I make the presentation and as I'm going through the dialogue. And it'll probably take a few hours to go through the presentation, so we won't have time to do it today. But on Fridays, when we have extra time, when people aren't ready to do their PowerPoints, I'll jump in and do finish off the presentation. And I want you to see, the level of thought, that went through the process of developing this. And pieces of the dissertation took years to develop. Okay. So the dissertation focuses on these main areas of research. One, commercial real estate. I'm using apartments as the property sector, in comparing the apartment property sector performance. The question is, why would you invest in apartments? I was working for an apartment REIT. It said, why would you invest? One, why would you invest in real estate? Why would you put real estate within your stock bond portfolio? And if you put real estate within your stock bond portfolio as a mixed asset portfolio, what asset classes or property sectors within the commercial real estate markets would you want to invest most of your money? The second was, how do you actually construct a portfolio? How do you actually pick the metropolitan areas that you want to concentrate your portfolio in? And then once you've figured out the metro areas, what submarkets you want to focus on to deploy capital? And then before I left the company, I was actually building a property selection model that would actually go through the whole inventory of apartment buildings within the given markets and identify those properties that we would want to own in our portfolio and do unsolicited bids on those properties and try to pry them from their owners. The second is portfolio applications, geographic diversification, and economic base analysis. How do we arrive at the optimal portfolio weights, both the active and the passive? You're doing that now. What are the portfolio performance measures? What are the exit strategies? Once you buy a property, usually what you'll do is you'll hold it until the rolling internal rate of return equals your weighted average cost of capital. At that inflection point, that's the point in which you either reinvest in the property or you exit the property. Because your IRR at some point is going to be below your weighted average cost of capital, and you're going to be getting a negative spread. Okay? And then time diversification. How do you time when to get in the markets and when to get out the markets? So you got to look at cyclical trends of the given markets and timing. When to buy, when to sell. Okay? Is this a good time to sell? Is this a good time to buy? It may make sense. It's like, almost like a real call option. Because management can say, well, we don't want to buy in that market right now because it's oversupplied and there's no real aggregate demand. But we're coming out of the recession, so maybe we wait 2 years until occupancy rates and rents go up and there's no new supply, and we can wait 2 years and then buy the property. So that ability to delay through management decisions is a real call option, and it actually adds value to the company by making those decisions. And then the postmodern application is, when we built the portfolio, now we got to find an index that tracks the performance, and if there's property derivatives or derivatives off of it, we can actually deploy capital into the derivatives in a long position to gain exposure quickly, or if we think that the market's going to go down, we could be riding the forwards and riding the futures and riding the calls on the futures and buying the puts on the futures. So we could use a derivative risk management strategy if the derivatives were available. And the assumption was that this market was going to develop. Okay. But unfortunately it didn't. They discontinued the market, and the property derivative market never came back after 10 years. I don't think it ever will. So the goals and the contribution, the primary goals and contribution of the research is to present a methodology associated with constructing a model of institutional grade commercial real estate portfolio using modern and postmodern real estate portfolio theory in its application. The key also was to educate real estate portfolio managers, institutional investors, and the academy in capital market theory applied to institutional commercial real estate portfolio construction and management. Modern portfolio theory had been established after Markowitz's work in 1957. Modern real estate portfolio theory didn't really come around until late 1980s and early 1990s, which isn't really that long ago. So the applications of modern portfolio theory had already been established in the fixed income and the equity portfolio theories and applications, but hadn't been done in commercial real estate. So what were our research questions and our hypotheses? Well, the first was, why would you put real estate in a multi-asset stock bond portfolio? How do apartment portfolios rank by return and risk compared to the other asset classes and the other property sectors? How do you select real estate markets and forecast performance? How do you build a forecast model using regression? What are the methods to construct an optimal real estate portfolio? What are the methods and metrics? that are utilized to benchmark performance and make hold-sell decisions, and what are the accepted methods of index development for property derivative trading, and why do you apply property derivatives to hedge or go long the market. Okay, now that you got the problems, then the question is, and the hypotheses, you got to go back and look at the literature and find out if there have been any books written on modern portfolio theory applied to real estate, if there's been any articles that were written in the academic journals, and if there's been any articles or papers or research reports written by industry professionals in trying to apply this, this approach. So the books, and Bodie King to Marcus is in there. I went through all the articles. This is just a sampling of the articles. If you go to the dissertation, you can see there's like 10 pages of citations, probably 20 pages of citations. So you have to do an exhaustive research to go find every single article about this topic. Yes, sir.
So yeah, I understand everything you're talking about,
yes,
but I don't understand how this like midterm and like blue book and all this works, because I'm like looking at literature review, and then like there's like tons of like different articles for literature review, so like
what you write down is you have to do an exhaustive literature search before you attempt to do this type of research.
Got it. Thank you.
Yeah. If you have any other questions or anything. The in-class midterm, this is the midterm, so I do the lecture, you take notes. You try to answer the questions, and then if you want to go back and review the PowerPoint and or the dissertation to add more content, you can go ahead and do that. Yeah, you're welcome. I just think I think this is an important presentation because it basically shows application. Yes.
Where in the course page is this PowerPoint? Because I can't find it.
Yeah. So if you go to the course page, right here, right down in the page, right underneath the SIE, you're going to have the questions. There's the doctoral defense PowerPoint, which is this one, and then here's the dissertation.
Thank you.
And then you may want to check your spam, also because I sent out all three of these today. It might have gotten caught in spam because the dissertation's so big. Okay? And be careful, the dissertation's like 360 pages. It's basically three dissertations rolled into one, because it was 15 years of work. Most dissertations are only like 100 pages. But I wanted to write the manual, so that institutional investors who wanted to build multi-billion-dollar portfolios of real estate have a guide to go from. Okay. Any other questions? Okay. Obviously, before you enter into this type of exhaustive research, you're going to need data, and you're going to need a lot of data, and you're going to need probably a data. They're called data scientists now, data analytics. You're going to need programmers to do a lot of this stuff, and you're probably going to have to learn how to do some programming to do a lot of this stuff too. So this is just one sample, of the series of data sources that we were using. So we had multiple databases, and then basically we linked all of those data sources into one huge data cube. They're called data cubes with multiple dimensions. And then what I did was I looked at all of these data sources and came up with an inventory of data, of variables, and then did the research and then identified the variables of the data that I had to basically construct all of the models, and then back test it and do all the statistics. So the research theory, then once you get the data, then you're going to have to apply the theory. You got to go out and find the theory, and then come up with the assumptions behind the theory, and then see if you can test the theory in real life to see if it actually works. And sometimes it does work, and sometimes it doesn't work. And if it doesn't work, you got to figure out a way to make it work. So the main hypothesis was that efficient real estate security capital markets require strong public and private sector cooperation, disclosure of government, corporate financial conditions, and institutional and individual investor confidence in both the financial and the political institutions. This is a macro institutional hypothesis. Because you can construct a portfolio, but if all of a sudden we go to war with Syria, and the Russians come in, and we go to war with the Russians, and NATO comes in, and the United States comes in, and you've got a Middle East war, your portfolio is going to get blown out. Okay, so the first thing you got to understand are what are the macro risks out there. When you're building models for real estate, the number one factor that you're trying to forecast is returns. Okay, I'm trying to forecast the direction of returns. It's just like the returns on the stock, it's just like returns in fixed income. You're trying to forecast returns on the direction for the real estate. Now, stocks and bonds, along with real estate, you're not using just one model, you're using a series of regression models with different variables in each of the equations. And there could be variables in one equation that are also in the other. So for example, you got to understand the accounting, you got to understand the financial ratios, because those are going to be inputs into your forecast model at the accounting level. You got to build finance-related variable models to be able to understand, inversions in yield curves and yield curve shifts and interest rates, that are affecting the finance and the capital markets. So you have to understand not only the macroeconomics, but also fiscal policy and their effects on real estate valuation and returns. You have to understand politics and policy that's coming to fruition right now. And once the policies and the politics are formulated, they're going to be passed and become law, and the laws are going to be administered through the bureaucracy, and there's going to be intended and unintended outcomes on your real estate stock and bond portfolios. And then all of this exists within a philosophical and a legal context. Our system here in the United States is Western European based. It's based on democratic capitalism, rules of law, based on precedents. It's different in the Middle East, it's different in Europe, it's different in Asia, it's different in other parts of the world. So you have to kind of understand the institutional arrangements in which your securities and your property and are located. Is it the United States? Well, what's the institutional framework? Is it Europe? What's the institutional frameworks? So you have to do an institutional analysis first before you can even construct the portfolio and start selecting the securities. It was pretty easy, I would say up until maybe 95, to be able to construct portfolios, both stocks, bonds, and real estate portfolios. It was pretty straightforward. That's all you had to do was add enough, assets to your portfolio whose returns had low, no, and negative correlation to eliminate the unsystematic risk and leave only the systematic and the non-diversifiable risk. The problem is for you and me is that in 1995, you had basically the peso crisis. In 97, you had the Thai baht. You had the Russian default in 98. You had Y2K in 2000. You had the dot-com bust in 2001. You had basically the housing boom bust in 2006, 7, 8, and 9. You had the financial crisis in 9, 10, 11. And who knows where we're going now. It's been 10 years. You have an inverted curve. You have basically sovereign debt and huge central bank balance sheets. You got repo market convulsions that are currently happening. We could be at the beginning of another financial crisis or another recession. So your ability to diversify now is a lot harder because there's just so much systematic and global and political risk that you as financial managers are going to have to exist in. You're going to have to be smarter, and you're going to have to use technology to be able to help. Yeah, go ahead.
So picking a bunch of assets with low correlations, lower your standard deviation, how is your return impacted? Is there like a inflection point like on the CAPM or inflection point on the capital allocation line where you figure that any more diversification doesn't really brings in diminishing returns? Or is
at some point in time you've wrung out all of the diversification that you can to eliminate the non-systematic component. So my thesis is that, okay, now we're confronted with more systematic risk. You can't diversify it away, but I don't believe that. I actually think that you can bring down this systematic risk component if you take on more non-systematic risk. So what you have to do as a manager either fixed income, equity, or real estate, is you really have to focus on your markets, drill into your markets, drill down to the property level or the security level, and start doing more attribution, both sector-specific selection, individual asset selection to take on more non-systematic. But the way that you leverage that strategy is by organizational structure, optimization, hiring the best talent, implementing the best software and hardware technologies to get the best information in real time, and then be able to manage in a dynamic, real world, but in a dynamic, continuous time environment, in a real-time environment, to be able to make decisive decisions to either mitigate the damage to the portfolio or to take advantage and leverage your position by making decisive decisions based on rules and based on huge amounts of data that are being crunched constantly. So you got to build the dashboards, you got to build the benchmarks to do. So the way that you do this, that you guys are going to have to do this, is to take on more non-systematic risk, to bring down the systematic risk, to immunize yourself from the systematic risk. And if you just look at the data shows you how much risk there is. I mean, just look at, this is just GDP, okay, since World War II. So you can see the volatility in GDP as we came out of World War II and went from a militarized economy to a consumer-based economy. And then the band, the volatility band, was narrowed as the Fed started to get comfortable conducting monetary policy to either slow the economy or accelerate it as we either was moving into inflation or moving into a recession. But this is the financial crisis right here. So you could see that recessions, from 1960 all the way up to this period, were fairly mild. But the financial crisis basically was a Six Sigma event. It was outside the 2 standard deviations for probabilistic, economic contraction. The question is this a new phenomena, or was this an outlier? I think this might be a new phenomena. So again, you're going to have to anticipate, because there's more volatility that you're going to have to manage. There's also more volatility in inflation, and you're seeing it now in oil price spikes and food spikes. They say that inflation is low, but the volatility is really high. Okay? So you're going to have to deal with inflation risk. And then obviously yield curve dynamics. Yield curve shift up, they shift down. The yield curve actually could go negative. It already has gone. Interest rates are negative in Europe and in Asia. If it comes here, God help us. But the yield curve now has inverted for the first time in 10 years. So how do you deal with that? And the yield curve is a precursor to stock market peaks and also recessions. The VIX index. During the financial crisis, look how high the volatility got. This was the volatility here in the 2001-2003 period. So the volatility was like, 3 times in the financial crisis what it was in the prior recession. And I think this volatility, depending on how the Fed handles illiquidity needs, could come back again. So again, you're dealing with more volatility. And then when you look at the fixed income market, this was amazing. These were the residential. These were residential compared to commercial mortgage-backed securities. These were the delinquency rates. Okay? So as you can see, delinquencies during the recovery periods are very low. And then once you start moving into a recession, the delinquency rates on these mortgage-backed securities start to spike. These were the subprime and the Alt-A's that were completely misrated and completely misunderwritten by Wall Street. Has Wall Street learned? Has the credit agencies learned their lesson? I'm not sure. So you're dealing with more default risk premiums. And here's the spreads that are unbelievable. These are commercial mortgage-backed securities. So if you're a fixed income bond manager, these are mortgage-backed securities, commercial mortgage-backed securities. So the tranches, the triple B tranches, triple B minus tranches that were are underwritten on some of these CMBS vintages, the yields on them went up to 10,000 basis points over. That's 100% yield maturity. When the yield maturities go to 100%, your bonds are worthless. Okay? And a lot of the banks were holding these worthless securities on their asset side of their balance sheet. So as they were writing down these mortgage-backed securities and these securities, the owner's equity and the capital in the bank were being wiped out. And the federal government had to come in and nationalize Citibank and had to inject equity into the bank balance sheets to prevent a run on the banks and a depression in the United States. In the REIT securities lost 75% of their value from peak in 2000 to peak in 2007 to the trough in 2009. But they came back really quickly. So the volatility was there, but you were able to recover the valuation very quickly. So my question was, if we're constructing portfolios in a more volatile environment, where's the volatility coming from? Where's the volatility coming from? So the first thing I did is you look at CAPM, right, which gives you your expected return, on the equity. You can use the perpetuity model. In real estate, what we do is we use the net operating income divided by the cap rate to get the value of the property, or we basically use the discounted cash flow model. Now, my thesis is that these cash flows, these NOIs over the holding period, along with the NOI, these are highly correlated to the business cycle. So if I know where we are in the business cycle, I can pretty much forecast these. So the volatility in these cash flows are not very high. So the volatility in the valuations are not coming from volatility in cash flows. They're coming from the discount rate. They're coming from the discount rate. And if you're using CAPM, the volatility is either coming from the risk-free rate, which is controlled by the Federal Reserve, or it's coming from the beta. And that's your systematic risk. So this got totally blown out. Okay. And this is where the volatility is right there, is in the systematic risk, which I just showed you on the prior graph. And then when you're building a discount rate, you start with the risk-free rate and you start adding on the risk premiums. Liquidity risk premium, credit risk premium, maturity risk premium. Maybe if you're dealing with foreign, mortgage-backed securities or foreign REITs, there's got to be an exchange rate component to it, and there's probably a country risk premium too that you got to tackle. Now those risk premiums, the credit default risk premiums and the illiquidity risk premiums, are, as they widen and narrow, is more volatile now than ever before. So the widening and narrowing of the risk premiums are more volatile now than ever before, which is causing the discount rate to be more volatile, which is causing the valuations to be more volatile. So modern real estate portfolio theory, or MREP2, we've already seen this before. So if I add real estate to my stock bond portfolio, it's going to bow out the efficient frontier because real estate returns have low, no, and negative correlation with stock and bond returns. So it bows out the efficient frontier. Reduces the expected return, but reduces the risk more than the expected return, so it increases the risk-adjusted rate of return. Commercial real estate economic and market analysis. When I'm trying to build a portfolio of real estate, I'm picking assets when I'm buying portfolios by sector and by geography. Okay? So the first thing you got to understand is that real estate markets go in cycles. Okay? They go through cycles, different phases of cycles. This line right here are occupancy rates and rental growth rates. Okay? In this period, there's no new construction, there's no supply, and there's no demand. So the market's stagnant. Occupancy rates are at their low and there's no rent growth. Then all of a sudden the Fed lowers interest rates, or the federal government lowers taxes, and it creates a multiplier effect and starts to create job growth through the multiplier or the accelerator effect. So as the jobs start to create, more commercial space is absorbed, occupancy rates start to rise, and rental growth rates start to increase. Then you reach a equilibrium point. For commercial real estate, the structural occupancy rate is 90%. And at 90%, the rents are growing at the local inflation rate. Then as job demand continues, absorption continues, there's no new supply because real estate, I can't underwrite, $1 trillion worth of real estate and bring it to market in, 4 months. I mean, real estate takes, in San Francisco, it's gonna take me a year or 2 to find the property. Then it's gonna take me maybe 5 years to get the permit. Then it's gonna take me another year or 2 to construct the building. So I could be looking at 7 to 10 years to bring product to market here in San Francisco or in the Bay Area. But if I go to Phoenix, I could probably get it permitted in like a month or 2, and I could have the thing developed in less than a year. So different markets have different cycles, okay? But since there's no new supply, and now you have demand coming from the job market, the rents start to spike. And as the rents and the values for real estate start to spike, at some point, the values exceed the cost of construction significantly, and that motivates developers to come in and start to supply the market. As they start to bring in more supply, the occupancy rates start to fall, and actually usually by the time the new supply is coming into the market, we've run through the business cycle, and the business cycle is starting to move into its deceleration phase. New construction, you're moving into the recession, there's more supply, but here the occupancy rate is still above the structural, and rent growth is still growing above the local inflation rate, so there's still incentive to bring more new construction. And then at some point in time, you fall into a recession, the markets are oversupplied, rents are falling and valuations are falling, and at some point in time the new construction shuts down because the price is down below the construction cost. So markets go in cycles. So where do you think San Francisco office is in the cycle? Is it oversupplied in a recession? No. Is it no demand and no supply? No. So are rents spiking? They've kind of gone through the rent spike, so we're probably over here, or maybe over here. So it could be San Jose apartments, San Jose office, San Francisco office, San Francisco apartments, retail, office, industrial, apartments. Those are the sectors, and then you have geographies. They could be metro areas or they could be submarkets. Okay, yeah.
So like when people talk about unemployment at an all-time low, or in the case of like the 2008 recession, delinquencies at an all-time low, a lot of people will argue that that's a sign of strong economics, but couldn't you also argue that that is perhaps a sign of like an inflection point, because generally things hit a super low like that, they don't last that long, and then
the labor markets are a lagging indicator.
right.
So usually you're going to see stress in the capital markets first before you see it actually occur in the real economy.
Right. Yeah.
So it's a lagged effect. So you're already seeing stress on a global basis, right? Economically. And what I'm waiting for is basically sovereign bond defaults to start occurring, which could be right around the corner. Right? So that was the cyclical approach, and everybody looks at real estate within a cycle context. But you also have to look at it, in a Marshallian microeconomic context too. So usually what you'll do is you start in equilibrium, right? And then you get a demand shock, right, which causes the rents and the values to spike. And then over time, as the new supply comes on, the market will reach a long-run equilibrium position as new supply is added to the market. In the Bay Area, the supply is constrained. So the supply curve never reaches its long-term equilibrium point. It's always constrained. That's why rents and rent growth and appreciation rates and values are always higher, because we're in a supply-constrained market. as opposed to a commodity market, such as Phoenix and Albuquerque, Texas, the South. What happens is that real estate is used as an economic development tool. So what they do is they approve, because they have so much land, they approve all these projects, and when the economy goes into a recession, they overshoot on the supply side, and the markets become overbuilt. So you have supply-constrained markets and you have commodity markets. Now, some people like to play in commodity markets. I'm not one of those people. I'm an institutional real estate economist. I select markets that are tech-oriented and that are supply-constrained because they've outperformed over the long run better than the commodity markets. Another market that's really interesting, because we'll talk about derivatives later, the derivatives market is completely different than the real estate market. Completely different. Because in the short run, for real estate, the supply curves are perfectly inelastic. Okay? Perfectly inelastic. But in the derivatives market, I was just listening to Jamie Dimon speak today, the derivatives markets are completely elastic supply curve. It's completely opposite. So the financial crisis and the solving of the financial crisis, the Federal Reserve basically printed $4 trillion and cleaned up all the bad securities and the derivatives off the bank balance sheets. How did we get into that situation? Well, the investment banks basically were in a perfectly elastic supply industry environment. How much does it cost to write and buy a forward contract between two banks? How long does it take to build a 1 million square foot office building? Let's say 7 years. How long does it take to write and buy a $1 billion forward contract between two banks? How long does that take? Yeah. How long does it take to build a 1 million square foot office building? 7 years. How long does it take to call up somebody at UBS from Deutsche and say, I want to write a $1 billion forward contract. Will you take that position? Will you buy that position? How long does that take?
10 seconds.
Exactly. Exactly. 10 seconds, it doesn't cost anything. So they basically manufactured the derivative contracts because it's a perfectly elastic supply curve. There's really no other markets like this other than pure commodity markets. You know, where the price in the elastic supply curve is basically the marginal revenue, marginal cost. It's the price. So the question was, why real estate? How does real estate compete against other assets within the capital markets? What I'm trying to do here is I'm trying to convince clients, institutional investors, that they should be investing in real estate. Okay? In real estate portfolios, real estate securities, and they should be using derivative contracts to hedge off the risk or take exposures. So the first thing is well, why would I put real estate in my portfolio? I got a portfolio manager, I got a fixed income manager here. He charges me a point. I got an equity, manager over here. He charges me a point. Why would I? And it's easy. These guys are managing $40 billion, and you're asking, you're going to charge me, 5 points, for $20 million. It's like, how does that work? I'd rather work with these guys. You're too expensive, and I don't. Why would I buy real estate? So you have to educate your clients. So this section analyzed the risk-adjusted returns for competitive financial and real estate capital market portfolios. The results show that risk-averse institutional investors are better off investing in apartments, particularly in the western region, and apartments in the west. And REIT investors are better off investing in western apartment companies. So to be able to do the analysis, you need the data. So we used the National Council of Real Estate Investment Fiduciaries to get the data. And then we used the S&P 500, we used some bond indexes that we basically calculated. And you guys know all this stuff, right? We calculate the expected return, which is the mean quarterly returns or annualized returns. and you have the standard deviation. High returns, high risk. Low returns, high risk. Low returns, low risk, and then obviously you want to be up here, right? High return, low risk. So what I did was I just basically calculated the means and the standard deviations for the time series and then plotted them. Okay. And what I thought was pretty interesting, this makes sense, right? S&P 500 rates, high return, high risk. This is what here was all of real estate, right here, and here was apartments. So apartments were actually providing you with lower risk and higher return compared to the overall portfolio, real estate portfolio. Here's your T-bills and your inflation right here. So you'll see these plots a lot, but this totally makes sense. Okay, but I thought that was interesting. Apartments actually did that. And then what I did is I did some behavioral finance, where I basically said, okay, risk averse, risk neutral, and risky investors. These guys are opportunistic, right? They're looking for asset classes that are basically oversold. These investors here, the risk neutral, are just looking for high returns. And then the risk averse investors are looking for the high return to risk ratio. And you can see, apartments rank pretty high compared to the other asset classes. They didn't perform as well because these are the ones that provide you with the highest returns. And then the risky investors were providing you with the highest risk. And they were, in these ratios, the return to risk ratios were beaten down during the cycle. Then I said, okay, well, apartments competed well against the capital market instruments. How does it compete against the other property sectors? So you can see it provided the highest return at the lowest risk. So as an asset class, within the real estate sector, my recommendation was, okay, you can invest in these for diversification purposes, but this is the best. This is the best property sector right here. Because it has demographic demand, and it also has financing mechanisms that the other property sectors don't have. So it has a comparative advantage over the other property sectors. And then again, looking at the return to risk ratios, ranked high, actually provided healthy returns, and then it didn't even come up on an opportunistic basis. So again, what I was trying to do was, through objective research, it actually ended up building the case for the apartment portfolio construction. How are we doing on time?
5 minutes.
Okay. So portfolio construction methodology. So the portfolio construction process starts with a detailed research and testing plan to determine the data, the forecast and selection models, dependent and independent variables. The results of the analysis assist in forecast variable selection, market rankings, and total return forecasting. The final stage is identification of geographic and economic-based portfolio diversification or concentration strategies, reflected in metro weights and target allocations or variances. So here's the methodology that we came up with. So the first was to go out and find the models, the regression models and the selection models. Collect the data, test the variables, create a forecast model using regression, create a selection model. So this was a meta-analysis using 2 methodologies and then comparing the results for validation. Then we created metro returns and rankings. We did a geographic diversification and an economic-based diversification. This would be sector diversification stocks. Then we determined the metro weights and then the target allocations. We used quantitative models, regression, qualitative models, surveys, and then we created a hybrid. We used cross-sectional multiple regression, Z-score, weightings, different methodologies to test the variables. We went into the literature to do external validation of the variables that we were using. In the first model that we did, since we were building an apartment portfolio, we said, well, apartment demand is basically determined by housing demand. So how is housing demand derived. Aggregate demand for housing is driven by these 4 factors. And this has all been validated from the literature. Number of persons per household, home price appreciation trends, income per household, inflation, and employment. If I can forecast housing demand, I can forecast apartment demand. Same thing with supply. If I can forecast housing supply, I can forecast apartment supply. So the 5 factors that drive supply for housing is inflation, consumer confidence, GDP, home price appreciation, interest rates, and affordability rates. So then what we did was we did the research, we came up with the factors, we created z-scores around these for each of the individual markets, and then we weighted those factors to come up with the index scores for each of the markets. Then we added up the scores, re-ranked the markets, and the results, and the recommendation to the investment committee when I was building the portfolio for the REIT and the pension fund, was that we should put the majority of the allocation of the capital into these top 4 markets, because they have the best economic base, the highest concentration of tech and highly educated, highly skilled workers, and also were supply-constrained markets and showed outperformance in appreciation rates and in rental growth rates over the long run. These markets were basically watch market or hybrid markets, and these were commodity markets. What we ended up doing was investing $2 billion into these markets based on the research, and we ended up liquidating the portfolio in these markets and redeploying the capital into these. Okay. Are we out of time?
1 minute.
Yeah, why don't we just leave it right there and go into more details. So on Monday, I want to look at the fundamental worksheets, technicals, portfolios, so we can start moving forward on that.
But that doesn't.
One of my students in my other class